Ever wondered what's really going on with a company's money? Well, it's not just about making a profit, it's about being honest about it. Today, we're going to pull back the curtain on the super strict rules that every single company has to follow when they report their finances.
So let's just jump right in with the most important question of all. From a tiny startup to a massive global corporation, what is the one thing, the absolute bare minimum, they legally owe the people who own a piece of the company?
And here it is. This is the answer, a true and fair view of their finances. Now look, that's not just some nice-sounding corporate phrase. It is the absolute bedrock of how the whole system works. It's a legal and ethical promise to investors.
Which brings us to our first section. This isn't just a suggestion or some kind of best practice. We are talking about the law, plain and simple.
You see, under India's Companies Act of 2013, the rule is crystal clear. Putting together these financial statements is compulsory for every single company. It doesn't matter if you're huge or tiny, rolling in cash or just scraping by. If you're registered, this rule is for you.
In Section 129 of the Act, it lays out the whole game plan. First, the reports have to give that true and fair view. They have to be done every single year. They've got to follow the official accounting rulebook. Then, the board of directors has to give it the thumbs up before it's finally shown to the shareholders at the big annual general meeting. It's a whole process designed to make sure everything is spot on.
Okay, so we keep saying financial statements, right? But what are they, really? Let's take a look at the actual blueprint.
Honestly, the best way to think about it is like this. If a company were a student, its financial statements are its annual report card. It's a formal set of documents that all work together to paint a complete and hopefully honest picture of the company's financial health for the past year. Now, this report card isn't just a single piece of paper. Nope, it's more like a full toolkit. So let's pop open the lid and see the 5 essential tools that make up a complete set of financial statements. And the law is super specific here. It says that a complete official set of financial statements has to have 5, count them, 5 key components.
And here they are. You've got the balance sheet, the statement of profit and loss, the cash flow statement, the statement of changes in equity, and the notes to accounts. Each one tells a different but equally vital part of the company's financial story.
So first up is the balance sheet. This is like hitting pause and taking a financial snapshot. On one specific day, this is what the company owns, and this is what it owes. It's a freeze frame.
Next, the statement of profit and loss. Now, if the balance sheet is a photo, the P&L is the movie of the year. It shows you how the company performed over the entire accounting period and answers that one simple, brutal question. Did we make money or did we lose it? Then you have the cash flow statement. And this is so important. Because, profit on paper is one thing, but actual cash in the bank, that's a whole different story. This statement tracks the real money coming in and going out. It tells you if the company is actually generating cash to stay alive.
And we can't forget the last two. The statement of changes in equity basically tracks who owns what and how that shifted during the year. And then you have the notes to accounts. You can think of this as the essential fine print. This is where the company explains how it got its numbers and gives you all the crucial context that makes the big numbers make sense.
So you're probably thinking, okay, 5 documents for every company. Got it. But what if I told you there's a twist? Because in the world of rules, there's almost always a surprising exception.
Which leads to the obvious question, right? Does every single registered company out there, no matter how small, really have to prepare all 5 of these reports every single year?
And the answer, maybe surprisingly, is no. For most companies, yeah, all 5 reports are absolutely mandatory. But the law carves out a little break for a specific group of smaller entities. For them, the cash flow statement is not required. So who gets this pass? Well, it's basically 3 types of businesses. A one-person company, or OPC, companies that are officially defined as small companies, and dormant companies, the ones that aren't actively trading. For them, the paperwork is just a little bit easier. Okay, so we've gone through the rules, the documents, and even the exceptions. Let's take a step back and ask the most important question. What's the whole point of all this paperwork anyway?
It all comes back down to this one powerful phrase, pulled straight from the law. This is the guiding star, the North Star, for absolutely everything we've talked about. Every number, every statement, every note has to serve this one single goal.
And why is that so important? It's pretty simple, really.
This one principle is the glue that holds the entire market together. It creates transparency. That transparency builds trust. And with that trust, investors and shareholders can make smart, informed decisions about where they put their hard-earned money.
So that leaves us with one final thought to chew on. If every company has to provide these reports, if this is just the ticket to get into the game, what actually separates a good business from a truly great one? Well, that's where the real story begins. The story that's hidden in the numbers.